Hey everyone, me Kevin here. Let's talk about Tattooed Chef, a vertically integrated plant-based meat producer with massive growth potential. In this video, I'm going to explain why the heck I sold this stock. So this actually goes back to February 16th, which happens to be right before this entire panic and crash we've seen in the marketplace. And the easiest thing to do is kind of show you where Tattooed Chef got caught up. Take a look at this. This is my Weeble. It's literally sell, 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 sell. A lot of stuff here. I mean, look at this. Snowflake. I mean, 40 shares, but still. Snowflake, February 16th, sold. Tattooed Chef, here, sold. 4,000 shares on February 16th at $24.59 a share. Tattooed Chef began as a stock on February 16th that I sold to free up a substantial amount of margin. I was getting a little bit worried with some of the things I was seeing in the market, and I sent a massive alert that I was selling somewhere around $1.6 million in stocks, and these were not necessarily stocks I didn't believe in. Like, for example, I sold Xpeng. A company I totally believe in, at $45 and 600 shares worth. Why would I sell Xpeng? The big goal I had right before this market crash, and I didn't know that a market crash was going to happen like 3 days later or start 3 days later. My big goal was I need to get my margin down. I'm sitting at 30%. It's too high. If and when a market crash comes, I don't want to be going into it at 30%. So I sold off about probably somewhere around $1.6, $1.5 million of shares. It's a lot of stocks. It's a lot of stock that I sold off. And Tattooed Chef was one of those. I have Tattooed Chef in 3 places. I have about, at today's price, I have about $20,000 at M1 Finance, probably somewhere around $25,000 before. Chase was probably around $55,000 before. It's around $41,000 now. And then I had, back then, this was about a $100,000 sell order back in February when I sold it. So my thinking was, okay, we've sold a lot. We've obviously been through this crash. We've since had this recovery, and we've had Tattooed Chef earnings coming up. And I've had this concern that potentially, as we escape COVID and the pandemic, that freezer foods are going to be a little bit more difficult to sell. I personally have been eating the Tattooed Chef product. I've ordered it multiple times, and look, it's good. It's not something I'm jumping up and down for. It's not like, oh my gosh, give me some of that brown bread from the Cheesecake Factory when you sit down and you're like, oh my God, I gotta have it. It's okay. It's good. It's plant-based food. They've got some things that I love. They got some things that are like, yeah, I probably won't order that one again. But that's the point. You have choice, right? And so I really like the company. And I thought, okay, well, when earnings day comes around, let's see how their earnings go. And as long as there are no red flags that come up, I will buy back into Tattooed Chef. That was my plan, to buy back into Tattooed Chef, because I previously broke down an analysis that I thought this stock will in the future be worth much more. And things have changed a little bit. And so in this video, I'm going to explain the 3 particular reasons why I'm selling Tattooed Chef. Especially, and this specifically has to do with current market pricing as well. Okay, so reason number 1 has to do with advertising and margins. So let's break this down. This is a little bit tricky. So the easiest way to start breaking this down is to play you something from the earnings call. So let's pull up the earnings call. Okay, I listened to the entire earnings call. This is actually somebody who re-uploaded the earnings call, so shout out to Finance with Alex. Thank you for re-uploading this. But I listened to this live when it happened. I took notes on the whole thing and listened to it live. And this was the part that I wrote down as a big question mark. And then I listened to the entire earnings call again, and I started putting some dots together, and I'm going to explain that bottom line to you after I play this for about a minute. Let's play it.
But I think you talked about the advertising strategy, and I was wondering if you've turned that on much so far in 2021, and what has been the response? What are the learnings with what you've seen thus far?
I'm going to turn that over to Sarah.
Hello. So, with Tattooed Chef, we've had no marketing until 2021 of January. And in our first phase, we were really focusing on banner ads and just gathering the data that we need to pivot and be strategic with where we allocate our dollars for marketing. We're going to be pitching and launching in March our commercials, which will be going digitally and connected to connected TV, but right now we're just still gathering data because we want to really be specific and strategic in where we allocate our dollars.
What happened is Tattooed Chef hired a marketing firm to get Tattooed Chef, the brand, the product, really well known in the market space, so that people, when they go to Target, they get the feeling, that emotion that ads give you of, oh, I've seen that on TV, I want to buy that. And that's good. In fact, they just said something that was really, really good. They said, hey, we actually haven't advertised since January, or we didn't start advertising Tattooed Chef since January. And remember, this is actually really important because Tattooed Chef is a new product. The company has been around for almost 20 years, and that's because they import their vegetables and their product from Italy. And they have been doing a lot of private labeled products where essentially they say, oh, hey, Kirkland, you need frozen pizzas? No problem. Here, we'll make you a frozen pizza. And they let like a Costco slap their brand label on it, and it goes on. I don't know if exactly it's Costco, but that's pretty much what this company has been before they renamed it, because it was a different company before. And you can watch my last video on this and see all of the history about them. But basically, they do a bunch of private labeling. Now, they're like, well, hey, why are we doing all this private labeling for other people? We got the imported vegetables and product. We got the facilities. Let's make our own private brand. And so the Tattooed Chef brand is brand new. Now, they've done very well here over the last 6 months with growing their product sales from basically zero to actually having sales for the Tattooed Chef brand. And I have a little bit of a concern about where potentially a lot of those sales have been coming from. Now, I want to first say that and this is very important, when you're looking at doing an analysis of a company, it's very, very important that if you look at year-over-year metrics, like, oh, something's up 300% or whatever, you got to understand, where did it start? Did it start at 0 or 1 and then go to 3, right? It's kind of like Tesla. Look, if you're going to produce 500,000 cars, are you going to go up, and you go up to 1 million cars year over year? That's 100% growth. That's huge for manufacturing. 100% growth. Huge, huge number. But, if you go back to the earlier days of Tesla and you go, oh, they went from 80,000 cars to 160,000 cars, well, that's a double as well, right? But you could potentially look and say, hey, they went from 40 to 160. That's a 4X. That's 300%. That's amazing. The landscapers are back. Oh, it drives me nuts, but oh well. So a 300% growth is obviously 4X. But anyway, why does that matter? Why am I saying this? It matters because we've got to be careful. This is a new brand. That is what's so important here. This is a new brand that's SPACed. And when a company SPACs, what happens? A company becomes very, very popular, potentially for a shorter period of time, because everybody's interested in the stock. Everybody's interested in SPACs. They're the hottest thing since sliced bread in the stock market. People love SPACs, so you get a lot of SPAC attention, stock attention to people who like the stock. They buy the product. The problem is, we have not yet tested this growth amongst, in my opinion, the regular mainstream consumer in response to their ads. Why? Because they haven't done any advertising. Great, they've got product placement. They're in Sam's, maybe they're, I don't know, maybe they're in Costco, they're certainly in Target, I know that. That's great, they've got the connections to get in the stores. That's wonderful. But I have concerns when I hear, okay, we're gonna start our advertising campaign, and I have no idea if they're good at advertising. I think their food is okay, some of them I really liked, but I have no idea how effective their advertising is going to be. It's a complete unknown. And don't get me wrong, I love the food in overall. Like I would recommend the food to people. Again, some of the products I would recommend over others. But I have some hesitation that with Tattooed Chef, I'm placing a bet on the advertising company's ability to not only spend their dollars properly, they're talking about digital ads, they're talking about connected TV ads. I mean, fine, look, companies got to advertise. In fact, if you go over, let's jump on over to Deloitte here for a moment. So if we jump on over to Deloitte, a report that they put together on marketing budgets by industry, the biggest marketer by industry is the consumer packaged goods segment. So here I am doing a fundamental analysis on this company, 3-4 months ago, and I'm like, these numbers are looking sick. And I didn't even realize at that point, one of the reasons potentially the numbers were looking so sick was because the company was getting all this free advertising through SPAC World. Well, now we got to put a big fat advertising budget in. And it makes me a little bit more nervous. That's because previously I was looking at some of their margins. I'm like, wait a minute, like there's some real growth potential here. These margins can really come up. But now I realize, wait a minute. We haven't even begun spending money yet, okay? So, okay, fine. But I mean, who cares? Like if the valuation's great, who cares, right? Well, that's where it's worth looking at some numbers. Now, I'm not gonna, look, I did a 30-minute video on this in my private course yesterday, which if you don't know about it, it's linked down below. I've got a program on the stocks and psychology of money, and I teach fundamental analysis, my way of doing fundamental analysis. You don't have to agree with my opinion of fundamental analysis, but at the very least, you probably wanna pay attention, like, you don't even have to like me, but at the very least, pay attention to some of the arguments, and if you stay in the stock, I encourage you to. I think the stock's gonna go up in the future. I'm gonna explain why I sold though in a moment. And all of these reasons compound. So pay attention to some of the things. Okay, so these are the actual numbers. Again, I'm not gonna go like crazy into detail on this. These are the actual numbers here. Then what I did is I made some adjustments because the way they reported the numbers was a disaster. It was very, very confusing. For example, they reported operating expenses of $7.8 million. And look, in the earnings call even, they said we know the numbers are kind of a disaster this month or this quarter because of the things that happened with SPACing and that. And say they put in about $3.4 million in stock-based compensation. So what I did is I backed out that 3.4. They're going to continue to have their legal fee costs for being a public company, so I didn't adjust those out. I took out the stock-based compensation to understand kind of what kind of operating expenses they're running at here, and if they would have been profitable. And if I remove this benefit this stock-based compensation cost, and I remove their income tax benefit of $41 million, which basically came from them converting from an S corp to a C corp. They got this big stepped-up tax basis that let them take a massive write-off. Good for them. Hey, they took a quarter that was basically going to potentially be a money-losing quarter, because if you don't take out the stock-based compensation, they would have lost money that quarter. And that income tax benefit was really, really good to keep them in the green, and substantially in the green. But when we adjust both of these things out, the stock-based compensation and the tax benefit they got from a transition, I think they probably had a quarter of about 4 cents of earnings per share, which is actually very good, because they were only estimated to earn 3 cents per share. So that's fine. This is all the good. And we're not going to go crazy deep into all of this here, but this is where some of my concerns come from. So their 2021 projection is 222 mil in rev. They are also projecting that they can get to 20 to 25% margin for the product. Now, they do not include in their margin advertising. That is a separate line. That comes in under operating expenses. They throw advertising for the product in SG&A, which is fine. A lot of companies do it. Some people put in a cost of goods sold. Some people put it down there. You can do whatever we want. You just got to know those things. So, okay, fine. I like to go conservative, so I go with the 20% here. That would mean that this company is bringing somewhere a gross profit of around 44 mil. Then the company projects this. They project that their earnings before taxes, interest, taxes, and amortization will be between $8 to $10 million on 44 mil. This was a little concerning to me, because then I could backwards engineer and go, wait a minute, that means you're expecting to spend $36 million, which means you're expecting to double your operating expenses in 2021. You're gonna double your expenses, but you're nowhere close to doubling your revenue. Maybe you're gonna go up 40% in revenue. That's your projection. So double the advertising or double all the operating expenses because of all this crazy advertising you're gonna do to get a 40% boost in rev. Now, it's possible that with food, maybe people come in, they see the ad, and then they love the product, okay? Look, if you get advertised to, like if DocuSign, a SaaS business, advertises to you, and you're like, I'm gonna try this DocuSign out, and you're like, oh, damn, this is a nice product. You don't need to be advertised to again. you're done. You're like, sign me up. I'm using DocuSign for everything. I'm game. This is freaking dope. You don't need to be advertised to anymore. Like the churn rate is very, very low. That's not true in food. In food, people's taste change. You have to continue to be advertised to. Food is notorious for being one of the lowest margin industries that exists. And this is not to say, again, that Tattooed Chef isn't going to go to the moon. I think the stock is, I think the company's a great company. I want people to make money investing in Tattooed Chef. And I'm going to get to why then would I not buy back in after having sold, over $100,000 before this market crash. Which obviously I sent out all of the alerts. I had a big spreadsheet of all the sales that I did to reduce my margin, and I explained that. But anyway, so let's go back to the spreadsheet here. What else is going on? What are we seeing? Well, so going back to the spreadsheet here, we got these massive expenses and not necessarily massive revenue, and those are their projections. Now, maybe they'll have the 10 mil in EBITDA, which they've suggested, but if they have these numbers, then they're really only going to bring somewhere, well, actually, they projected it. I don't even have to calculate it. They said it. They projected we're going to have $2.5 to $5 million net. So even though I went conservative up here with the margin with 20%, which keep in mind, right now they're at like 16%. And so they're 16% on their gross profit margin right now. And their suggestion is that, hey, when we get more products, we're going to be able to increase this margin. Fine, I can jive with that. You got more products. I know you're putting your R&D into that, but you can get products to shelf fast. Fine. Maybe you can get your margin up to 20-25%. That's great. Maybe the 25% ends up being the game changer. But they're projecting $2.5 to $5 million of net income for 2021. This is very low. This is 2.25%. If I go with the big number, 2.5% is $5 million in net off of the 222 in revenue. That's very, very low. With my projections, the first time I analyzed this company, I thought they would be able to at least bring 5% to the bottom line in 2024. Now I'm going to revise that down and just use 4%. But not only that, I also thought their operating expenses would go down with scale. But I totally missed that they weren't, and maybe call it my fault. I don't care. Blame me. It's fine. I totally missed that, wait a minute. Their big advertising boom is coming in 2021. Now, maybe the advertising is really successful and this company moons, okay? Totally, entirely possible. Totally possible. Then you know what? Me, Kevin, was wrong. It's totally fine. But if we bring 4% to the bottom line in 2024, what does that mean? Well, that means we've got 27 cents of earnings per share, and they're going to have way more shares, obviously, in the future. Right now, we're only using 73 mil shares, but that's just what we're going to use for our projection right now. That puts this company at a 75 times forward PE ratio at this projection. Call the projection low, right? Maybe 30% growth compounded is too low. Maybe if they advertise like crazy, they'll have more growth, but wait a minute. The company themselves is suggesting that on their first year as essentially as a startup, because they're a startup, even though they've been around for 20 years, Tattooed Chef, the brand, most people don't know about Tattooed Chef, unless you're in the stock. Most people don't know about Tattooed Chef yet. So in their first year, they're gonna double their operating expenses to get 40% growth. I think 30% growth for the future years is reasonable. Who knows? Maybe they can double. Maybe. And that's not what, and I'm not, look, the Bloomberg terminal, I don't have it up right now. I'll try to pull up the Bloomberg terminal in a moment. Bloomberg terminal doesn't project more than 500 million in 2024 either. Now that doesn't mean that they're right, and it doesn't mean that I'm right. I'm just saying, like 30%, these are the numbers I'm using. If you want to play with different numbers, more power to you. I appreciate you watching this. We're talking about numbers in a boring spreadsheet here, and it's like we're having a fight over, we should be using 40% compounded. I think we're all on the same page. Like, we all want to learn what's going on here, right? So for me, a forward PE of 75, folks, I'm a buy Square. I would rather buy Square, which has a forward PE of 75 per my numbers and my analysis. I would rather invest in Square because guess what happens at Square, folks? Square comes out and says, yo, we got Tidal, the music streaming service. We're going to monetize every song on this platform with an NFT. Roll in the dough. Folks, I am not going to spread myself out too thin when I could concentrate into stocks that I have higher conviction in. What do I have higher conviction in? Square, playing Cash App Bitcoin, reopening play for companies, coming out with banking services, credit cards, and potentially NFTs. at 70, I think it's 72 times forward 2025 earnings, for what we're paying now, or paying a forward PE of 75 for a food company that I know is low margin, that has untested advertising. It's untested. They just started in January. And potentially, well, I know is in a low margin industry, but potentially just has to continue to advertise to continue to get those clients to keep coming back and back and back. It's not like you're advertising, a Tesla, where once you get your first Tesla, you get your car. And the cool thing about Tesla is they're not even advertising, right? Like, that's what I would rather have my money there in some sense. So I don't, to me, look, I think Tattooed Chef, if I was going to pick a food company, I'll certainly buy it over Very Good Food Company, which Very Good Food Company I did hold for like 2 weeks, and I did sell that. They had some really, really good production numbers. Maybe they can get to some really, really big fat production with some of the new partnerships and plants they've got coming up. I'm excited about that for the Very Good, butcher, Very Good Food Butcher. Yeah, I mean, look at this. Yeah, like, I'm projecting like crazy here, but if they get to 20 mil in revenue, they're selling for 22 times rev. Tattooed Chef at 22 mil 2021, that's 7.8 times revenue is what they're selling for. Beyond Meat is only selling for 5.65. Like, on these revenue numbers, I'm actually getting a better deal at Beyond Meat. Now, look, Tattooed Chef, if they were able to keep this growth up that they had when I first invested in them without having to start a new advertising campaign as a new company, then I think margins could compress. They could increase their profit margin on the product. They could decrease their expenses as a share of the company's operations. But it's too much of a risk for me. And so with that said, I would much rather be investing in some of my other companies. And I'm certainly not going to go into margin to add back into Tattooed Chef at this point. That's just my take. And this doesn't mean that the stock is bad. It just means I think I have a better opportunity somewhere else. That's it. Especially at today's prices, or I should really say like Monday and Tuesday's prices. That's the last time I bought. No, it was Tuesday was the last day I bought. Tesla, Enphase, Etsy, right? These are some of the ones that I bought. Obviously, even those purchases are doing very well right now. But I'm not a short-term player. You know that. I'm a very, very long-term, unless I'm swing trading, that's different, but that's usually with a very small part of my portfolio. That's been doing very well as well. But for this company, look, if I'm going to go long, I'd rather go long in something else. I do still hold about, right now I've got $18,600 in M1 Finance, which I will sell. M1 Finance was down yesterday and haven't actually sold it yet. And then I do have about $40,000 in JP Morgan. Honestly, I don't know that I can actually sell my $41,000 at Tattoo Chef at JP Morgan because all my stocks are frozen there because they basically what they do is they freeze your account and they're like, okay, cool, we'll give you a margin line of credit on this, but it doesn't work if you want to actively trade. And I'm like, I don't want to actively trade, just leave it all there. And they're like, okay, cool. So I'm not sure that I could get that 40K out of there. But I'm not worried about it. I'll leave it there. I'll leave the 40K there. I'll sell my M1 Finance. It's not going to be part of my pies anymore. But this isn't like a breakup. Like I'm not worried about this company. Like I don't think this company is going to fall in value. It's certainly not, I don't think it's worth less than $20 a share. I do think this company has potential to be, a $30, $40 stock. Do I think it's a $60 stock anymore? No. Is this a $30, $40 stock in the future? Yeah, maybe. But in the meantime, what's Tesla or Square going to be at when that time comes? So that's my POV. Food, too low margin, advertising, new advertising. Look, they could hit it out of the park or not. I don't know. So my thoughts. Thank you very much for watching. Hopefully you found this insightful. If you did, consider sharing, subscribing. And folks, see you in the next one.